We are going to start today's session with a conversation with Mark Phillips, founder and managing partner of 11 Tribes Venture out of Chicago. Mark, welcome. I'm looking forward to getting to know you.
It's wonderful to be here, Sramana. Thanks for having me.
So, Mark, tell us a little bit about 11 Tribes Ventures. What is your fund size, investment thesis, just an overview, and then we'll dive into AI, which is the current
Yes.
seed case.
Yes. Well, I really appreciate how you opened the conversation here because we see the world a bit differently too. I think in order to adequately describe what we do, if I may, Sramana, I'd love to just share a brief background of my history.
Of course.
I'm based here in Chicago. I'm trained as a strategy consultant. I worked at Accenture for years. And then I went to business school, and while there, I started my own company. And I was in Chicago building a health tech company called Diasense. It was a hardware device designed to help type 1 diabetics better and more passively measure blood sugar. And I drank all the Kool-Aid of kind of the coastal mindset of venture capital. And I think one of the things that I hope every entrepreneur on this call listens to is you have to build a company that is right for you. Yes. And I think what I was trying to do, Sramana, is I was trying to build a company that was right for everybody else. Mm-hmm. And it will come as no surprise to you that company, whether it was spectacular or not, it failed. Mm-hmm. We got leapfrogged by a better product. We ran out of cash. Morale completely, crumbled around us. And ultimately that business was shut down. And I share that story of failure because it was failure, because it has been such a seminal moment in my life. I went through a pretty startling identity crisis because of that, Sramana. Yeah. Just dealing with what is my value? Who am I if I'm not building this company? And even as a person of faith, that was a really important process for me to go through. And I look back on that failure with a ton of gratitude because I think it helped me understand who I am, what I care about, and what's the work that I want to do in this world. Mm-hmm. And so we started 11 Tribes with that backdrop of, yes, business outcomes are great. I am a capitalist at heart. I want everyone on this call to make plenty of money and have a lot of financial success. But there's another half to the equation beyond the business outcome. We call it the founder outcome. Mm-hmm. What does the mental, emotional, physical, spiritual health of that entrepreneur look like when they have either shut down the business or sold it to some type of competitor or strategic buyout? When you exit that company, what is the quality of the things in your life that are most important to you? And I think the challenge that as entrepreneurs we run into is because we care so much about what we do, because the business we are building is like a child to us. Mm-hmm. We convince ourselves that we can put things like our mental health, we can put things like our relationships with family and with friends, we can put things like our religion or our faith to the side and say those will be there in 10 years. But the problem is they will not. That is not true. Yeah. And so as a firm, we exist to be the firm where capital and care are focused on the founder. We make an allocation of, we call it our founder resilience commitment. 2% of every dollar we invest goes directly to the entrepreneur for them to put towards their resilience. That's coaching, it's counseling, it's leadership development, it's organizational health, and that's non-dilutive capital. So if we put $1 million into a company, we have a $20,000 grant that comes from our fund and goes directly to that entrepreneur. We're so excited about that. It's so amazing to have a base of investors, limited partners, as we call them, who are willing to allow us to use the capital in that way. Mm-hmm. And it really informs the decisions we make as we think about what are the type of companies, and more specifically, Sramana, who are the founders that we want to be partnered with. Mm-hmm. So that's an important backdrop. You can tell I care a lot about it because it's a very personal experience for me. And so we now exist. Please.
Let me just comment on what you said. I think it's the problem with the venture capital model that we have arrived at this point over the last, let's say, 30 years, is that it is all consuming and the investors expect the entrepreneur to put everything aside except for making the venture a success, and that success has to be success that makes the investors money.
Yes.
Otherwise, it's not considered a success.
Yes.
If the investors don't make money, the founder's not going to make any money at all. So 7 years, 10 years of life can end up in nothing by way of wealth creation and what is determined as success.
Yes.
So that's a very depressing outcome. That's a very depressing scenario. But I think the balance of mental health, balance of life, family, relationship, it all goes by the wayside.
Indeed it does. And, you know, I don't want anyone to hear this and think that we're taking the easy way out, Sarmana. I think we're simply addressing the facts. Harvard had a study that they did, which has been cited many times over now, where they found that 63% of startup failure, the founder will attribute that failure to people-related issues. So this isn't just a nice to have. This isn't me patting myself on the back, trying to make myself feel better because I'm helping people. I am, and I'm proud of it. But it's also, in our estimation as a firm and as an investor, a strategy. It's a risk mitigating strategy to say, hey, maybe 2 or 3 companies in our portfolio would have failed because of co-founder conflict. But because of our mindset, because of the thesis we bring to our partnership, and because of the founder resilience commitment that we've made, that co-founder conflict is avoided. It's a value creation mechanism, and it's been amazing to see it really come to life throughout our portfolio.
So I hear you. Now let me ask you for the more traditional part of your business, which is venture capital.
Indeed.
Venture capital, you're in the business of venture capital to make money. You're not in the business of venture capital to not make money. So now tell me, what is your fund's investment thesis?
Indeed. I appreciate that. We are here to make money, and if we do not make money, then investors stop giving us their money, and we cease to have a business, as you understand full well, Sarmana. Our thesis is indeed a little bit different, so it follows in suit with everything that I've just shared. I think the why, I hope, is very clear to you and to those that are listening. And I think if we were to suggest, again, we're a Midwest-based firm. Venture capital in the Midwest is still a little bit of an oxymoron, if I'm being completely honest. And so I think a lot of Midwest and non-coastal VCs have tried to play the same game. And when you see Andreessen Horowitz announcing just yesterday that they're raising a $20 billion fund to allocate into, early stage AI, if we try to play the same game as Andreessen, if we're simply scouts and getting them onto our cap table, we do not have the same return profile. We are not looking for the same types of deals. And so as you started this call, Sarmana, you alluded to this idea of we support diversity in terms of the way that people think about the way they want to build their business. And we feel the exact same way. When we look at the companies we're targeting, there's really 3 things that I would point out to you. The first and foremost is we are very price sensitive investors. I think as an asset class, we have lost sight of the fact that price matters. And many of these large funds are pumping 20s and 30s of millions of dollars into early stage startups who might not even have a real go-to-market strategy in place yet. But when you do that, what you do is you place, I think, unrealistic expectations on the back of the entrepreneurs who are taking that money. Because for all the founders listening, you have to understand each of these firms has an underwriting mechanism that they are operating within, right? So if you are taking $20 million on a $50 million pre-money valuation, well, that firm is at least underwriting your performance to 10x, probably something closer to 20 to 30x. And so all of a sudden, the only thing, to your point, Sarmana, that looks like success to that VC is a unicorn outcome.
Yeah, most VCs, and certainly Andreessen Horowitz, are operating with a unicorn chasing mindset. And Andreessen Horowitz, this particular fundraise is absurd, because to give returns to limited partners on a $20 billion fund,
it makes no sense.
It does not make any sense, because there aren't enough exits to give that
Correct.
level of return in one fund, because that's assuming that the entire industry's returns are going to go to Andreessen Horowitz.
One firm. Yeah. I think I saw a stat that if you do the math, they need to generate something to the tune of $600 billion.
$640 million.
Was it 640? Okay. Which is more than the last 100 IPOs in the tech industry. It's no longer, to the founders listening, you really have to get what the VC that's giving you money wants from you. And what Andreessen is really drawing the line in the sand is like, unicorn isn't enough for them anymore. Right. So now they've got the word decacorn, and they've got centacorn, right? $100 billion outcome.
And these speculative investments don't really, they end up, these unicorn chasing speculation ends up in unicorpses very often, right?
Indeed.
Because you're raising, as you gave the numbers, $20 million at a $50 million valuation. Well, it's not going to be a $50 million valuation. That's too much dilution in Series A. If you're doing a $20 million Series A, that's too much dilution. So that doesn't really work. If you're raising $20 million on a, let's say, $80 million valuation with no real goods, right? You don't have the MRR or the ARR to support any of this. It's all speculative. then you have to backfill that valuation before the next round of financing. Otherwise, you're going to have a down round.
That's it.
So
That's it.
this is a terrible situation. So anybody who's listening and who's thinking about, unicorn chasing, blah, 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 please of the fact that this is not to your advantage.
No, it's not. It's not. That's such wise commentary, Sramana. And that's, so you've asked me a direct question, and now I need to give you a direct answer. What are we doing? We're running as quickly as we can to the other end of the barbell. I think venture is quickly I think the venture capital ecosystem is going to become a barbell approach. The reason Andreessen exists is because there's these pension funds, there's these endowments that have massive amounts of capital that they need to put to work. And they want to park it somewhere, and they want to have a name brand associated with where they put that money. And so these firms are not going to stop raising these massive funds. But I think the thing that's going to emerge over the course of the next, 10 years is the proliferation of truly value additive emerging funds that are much smaller, right? Because when you have so we just closed, last week we closed our second fund. It was a $46 million vehicle. We had targeted 40 million. We oversubscribed by 6. We're thrilled to have this new capital in market, and we're actively deploying that money. And so as we look at the kind of businesses we want to find, we are focused on entrepreneurs that are generally located outside of the coasts. We want founders that are based in tier 2. We are a domestic investor, so we're really focused on North America at this point. We do hope to expand into the future. When we look at these entrepreneurs, we want folks that are, based in a tier 2 or tier 3 geography. So that's Chicago, Atlanta, Austin, Texas, Denver, Colorado. You get the idea, right? These ecosystems where there's less hype, I suppose, is what I would describe it as. And what we've really experienced, Ramana, is what I would call geographic price arbitrage. Simply because a company is building in Nashville, Tennessee, as opposed to Silicon Valley, as investors, I think we're getting something probably close to 2 to 2.5 times discount at the seed stage. Mm-hmm. So that's the first component. The second is what I would describe as capital efficiency. I think we are really subscribing to this idea of seed strapping, which many founders have probably read about over the course of the last 6 months. The idea of taking a moderately sized seed round at a reasonable valuation, using that seed capital to drive to cash flow break even, and ultimately making a strategic decision about whether they raise future capital moving forward or using the profitability of the company to grow their organization. Those are the kinds of companies that we really want to participate in. And from a sector, we are actually very agnostic. We will look at anything if it kind of fits those 2 criteria. And then the last piece I would describe is, I think at our core, what we really are is leadership investors. Everything I shared at the top of our conversation, those are the passions that our team holds. The idea that the leader is the only thing within the organization that needs to grow faster than the company is something that we really share with our teams and with our portfolios on a regular basis. And so if you give me an entrepreneur who has a unique right to win in the space, maybe they've worked in the supply chain industry for 25 years, they've seen a problem, they now know how to solve it, and they're stepping out and want to run a very capital efficient business. That is the type of entrepreneur, and that's the type of startup that we at 11 Tribes get really excited about backing.
What size checks do you write?
We are, out of Fund 2, we're writing a $1 to $1.5 million check into 25 to 30 portfolio companies over the course of the next 2 to 3 years.
Okay.
Generally, the rounds we're participating in are priced somewhere between probably $10 and $15 million pre-money. These are post-revenue companies by and large. So we're not doing a ton of pre-revenue investing at this juncture. And they're raising anywhere from $2 to $3 million of capital in that round.
Okay. So when you say post-revenue, what kind of revenue level are you looking for to invest in?
The strike zone for us is $500,000 to $2 million of revenue. And we're happy for that to be annualized. I mean, we'd prefer it to be realized, but I realize now ARR has really become a MRR times 12 as opposed to, hey, this is actually recurring revenue. But that's an annualized number of $500,000 to $2 million of revenue over the course of the last 12 months.
And you said you're sector agnostic. So this is not focusing on anything. You're willing to invest in anything you want. We are.
I mean, the best performing company in Fund 1, so this is Fund 2. Fund 1 was an $11 million vehicle. The best performing company was a direct-to-consumer functional mushroom coffee called Rise. Maybe a few folks on the call have tried it. RYZE. They've become a very dominant player in the mushroom category. Not a space that we had a ton of conviction in, but we met founders. The gentleman who runs it is a guy named Andre Rashad. Andre and Rashad run the company. And they're classmates from Harvard. He worked at Kraft Foods, felt like they needed a mushroom category. When they said that they didn't think that was the right strategic initiative, he moved home. He bootstrapped the business. He got it to $1 million of revenue very, very quickly. And when we looked at that opportunity, we saw someone who had incredible leadership potential. The business has gone on to perform exceptionally well. But I use that as an example, Sramana, of like, we're not just enterprise SaaS investors, right? We don't need everything to kind of fit into a square peg round hole situation. If you've got a great CPG product, if you've got a great piece of hardware that we think you have a unique right to win within that space, it's absolutely an opportunity that we will consider.
Have you done a hardware investment?
We have one in Fund One. It's a medical hardware device called BrainSpace, and it's helping solve a very real problem of relieving cranial pressure in hospitalized trauma patients.
And what is the go-to-market strategy through hospitals?
Yeah, directly through hospitals. And so they're months away from FDA approval. It does require FDA approval, but they've got a backlog of numerous hospital administrators and executives that want to use the product. The process of
pre-revenue, if it's FDA pending, how can it be post-revenue?
Yeah, so this was a Fund One investment. So that was out of Fund One. And as I talk about us investing in post-revenue, that is a Fund Two strategy for us. Fund One was a 2021 vintage. And as I kind of started at the top and said, price has always been very important to us. As we allocated out of Fund One, we didn't budge on price. What we moved on was the traction of the business itself. So Fund One has a few more pre-seed investments, but Fund Two, given where the market is today, will be an exclusively post-revenue business, post-revenue investment strategy.
So Mark, talk to us a little bit about, so we are a tech and tech-enabled services accelerator. We don't do CPG, we don't do medical devices. We actually only do software, and we would do hybrid hardware software, but it's all within the information technology domain. We would do e-commerce within CPG. If you have a CPG product that is a primarily e-commerce product or hybrid, that we would do. So tell me a little bit about, in Fund Two, what are you expecting to see? And I'm sure you have some sort of a pipeline and deal flow that's already built up as you are starting to divest your second fund.
Yes.
What is happening in your, in the geographies where you are interested in? Tell us more about what's happening in the tech-enabled services world.
Yeah. Thanks for aligning on that. That's helpful. And to be clear, the opportunistic things are probably 20% of the portfolio. There's still a huge 70 to 80% of what we're doing that are absolutely tech and SaaS enabled. And so that's an area we spend a lot of time discussing. We got to start at the top of the call by discussing the role of artificial intelligence. We will not invest in what I would describe as sort of the AI wrappers or even any of the underlying large language models, right? I think all of that fundamentally, in our estimations, Sramana, is a race to the bottom. I think when DeepSeek came out from China and we looked at the performance of it, I think it became very clear that the moat of these large language models was not terribly significant. And I think the other challenge from an investor point of view is we just have no idea what the pace of change is going to look like.
Not only that kind of business is not a small fund game.
Indeed.
That is a very large, that is Andreessen Horowitz's game.
You're spot on. And the theme here, that's spot on. You nailed it. And the theme here is, again, the mistake I made building my first company was I was trying to build it for somebody else. And who we're trying to be as 11 Tribes is the investors that is true to who we are. And I think that's a really important thing that anyone building a company needs to understand for themselves. Back to your question directly, I think one of the biggest things that we're really appreciating is that as we're investing out of this 2024 vintage, software CEOs are really becoming AI natives, right? And so it's not a question of how you're using AI and in what ways it's being integrated into your business. That's a given, right? It's a question of how are you using that AI enablement to create some prior or previously unattainable aspect of your company that is going to either create a better go-to-market strategy, a better customer experience, or a better retention strategy for the customers that you have already retained. And so it's no longer a question of like, how are you using AI? Are you using AI? Really, the generation of entrepreneurs that we are starting to see have been building for the last 2 years since the advent of ChatGPT, and they have become very proficient at integrating AI directly into the processes of what they're doing. So that's the first kind of component piece. I imagine you might have a comment there, so let me pause before I kind of talk about some of the other trends. Are you seeing something similar?
Well, the way we look at AI is different. Where you would find venture fundable AI companies is something I look at differently, and many of my colleagues here look at differently. In that most of them are bypassing the infrastructure layer where there is these large language models or very large data centers and so on and so forth, which is basically a money game, right? Money to scale game. And that's happening in the hands of big tech mostly, and companies like OpenAI and Anthropic. But most small fund investors are looking at the application layer where you can make use of all these different layers that are already in place. And the differentiating factor in that application layer is domain knowledge.
That's so well said. Yes.
You're doing something in manufacturing, then you need deep manufacturing domain knowledge to build something interesting. If you're doing something in pharmaceutical, you need deep domain knowledge there. So it's people, you're talking about founders. The founders that are prized are founders who bring that kind of deep domain knowledge with which to build something differentiated.
Yeah, you took the words right out of my mouth. I think as we look at our Fund 2 portfolio, we've actually got 8 companies in the portfolio today. And I think of the 8, 6 of them are first-time founders that are coming from industry. Okay. So one's coming from the hospitality space. One's coming from the hospitality space. One's coming from the supply chain space. Another spent a career in the regional bank and credit union world. And now he's building something that is AI native, AI enabled to help those credit unions better process business formation, wills, and trusts for some of their clientele. And so each and every one has this deep and abiding industry expertise that is allowing them to quickly and really efficiently solve a pain point and generate revenue for their customers, which brings me to really the second point that we're seeing. And again, I think there is going to, I'll be curious how you react to this one, given where we are geographically located. We are seeing a really quick shift away from, at least in the founders we're speaking with, away from this growth at all cost mentality to a capital efficient, cash flow break even. I want to control maximum optionality for my business.
Good.
And I think the question that begs for us, Ramana, as a fund is you can't have it both ways. You can't have a very, very low batting average and companies that are choosing to go into this cash flow positive, sort of more sustainable, profitable growth mechanism, largely because that second component I just alluded to, we have to be honest as investors, we are ultimately capping the upside, the overall upside of the business when we encourage them to take less capital. And so what we're building into our fund profile and into our fund modeling is actually a higher batting average. What we're seeing in Fund 1 today is we believe we can achieve a 30 to 40% success rate across the portfolio, underwriting the growth of these companies to an enterprise value of $100 to $150 million at exit. And so I've had folks who have said, hey, that's not venture. And I respect that pushback. It is definitely something different than what traditional venture has looked like. But again,
there's a very, people who know that most exits in software are less than $50 million exits.
Exactly.
So to play that game, to make money for everybody, including investors and entrepreneurs, to make money with a $50 million, under $50 million exit, you have to build very capital efficiently and get to, 5 million in revenue so that you can. But the trick there, though, still, to get that exit, there are 2 things you have to think about. One is you need still velocity.
Yes. So
how do you play that game of being very capital efficient, but still maintaining a certain amount of velocity that will make the company worthy of an exit? That is the tricky part of playing the game that you're trying to play. I know a lot of investors who are playing that game. I've brought them on here many times.
Sure.
If you go to Udemy, I have a course called Alternatives to Venture, Unicorn Chasing Ventures.
Yeah, that's good.
So that's that category.
Yeah.
But you have to be mindful about the exit strategy and the velocity part.
I don't think enough people talk about what you just shared there, the idea that the majority of software exits occurring, in that sub 50, sub $100 million. The actual statistic is of all M&A activity in North America over the course of the last 10 years, 96% of all exits occur sub $100 million in enterprise value. That's a overwhelming number. And you nailed it, right? So it's that tension between lifestyle business and hyper growth startup. what does the middle point of that spectrum look like? And those are the types of entrepreneurs, and those are the types of businesses that we're really looking to back. And
Yeah,
I think
you're still probably looking for hyper growth startups. But the reason being that to get an exit, you need growth. Otherwise, the people acquiring are not going to buy the startup. But you don't invest gobs of money in building the channel. You use somebody else's channel to scale, but you get it up to a point where using somebody else's channel is going to grow really fast.
That's right.
That is the game you're playing.
That's right. And you're spot on. We are looking for I'd say we're looking for hyper growth founders and who are building businesses that have the potential, but we aren't injecting the rocket fuel that is the 10 or $20 million, seed check that's going to place, like I had described, the unrealistic expectations on the back of the founder.
Yeah, that kills it. If you put $10-20 million out of the gate, then you cannot play this game.
No, that's it. And so it takes a strong alignment. It takes a lot of conversations. We actually have developed a handshake agreement. It's a one-page document that we've described and articulated as best as we can what we're talking about here, right? This tension between lifestyle business and hyper-growth mindset. What does it look like in the middle? And we actually ask each of the founders we invest with to sign it. And interestingly enough, Sramana, as we've used that document, we shared at about the 80% point of our diligence process. It's actually killed a couple deals. We send it to a founder, they read it, and they respectfully say, this is not the kind of business I'm looking to build. I want to go raise Andreessen Horowitz capital. I want to take this thing to $1 billion. And we shake their hand. We wish them all the best. It comes back to the whole theme, I think, of this conversation, which is build the business that's right for you.
Yes.
I don't have any judgment against those people. I wish them all the best.
Your identity is tied to building a unicorn and being an Andreessen Horowitz funded entrepreneur, then that's a different track. Indeed.
And it's not wrong. It's not the wrong track. It's just not the track that we're interested in. And I think to answer your question, again, this is kind of my last point. I don't think it's a track that a growing and burgeoning swath of the entrepreneurial ecosystem is interested in. I think a lot of people are thinking more about sustainability, durability, and profitability. And I think we're really excited to be, I feel like, on the front lines from an investor perspective of trying to back those types of businesses and those types of founders.
I'm sure in the category of entrepreneurs you are seeing in the geographies that you're catering to, that is a true statement. And yes, they're benefiting from the fact that the ultralight startup trend is really taking off right now.
It is. I think we could talk about that for some time, Sramana. What does AI mean for all this? And I would contend that I think the barrier to entry of getting a startup off the ground is quickly plummeting to zero. Even product differentiation is very quickly becoming something that is not a competitive advantage. You can code a new product, you can recode some product that already exists in no time at all. This is
the downside of the ultralight startup trend is the copycats are going to be absolutely everywhere. And too many copycats makes a venture in a particular segment, makes a company non-venture fundable.
Well, that's spot on. And I think the moat, the thing that allows them to win, becomes a couple of things, right? I do think leadership and the viability of the team internally is going to become critically important as these teams tend to shrink. I think we're going to see smaller startup teams. I think the community narrative, how are they creating a community in their customer database, right? Do those people who are buying your product feel like they're part of something that's bigger than themselves? And then I think ultimately it comes down to the go-to-market. Do you have a unique niche that allows you, whether it's a channel partnership or otherwise, that allows you to get your product into the hands of customers more quickly and more inexpensively? So those are the things we're largely evaluating as we look at the businesses in these geographies that we're focused on.
My take, if I were you, would be to look at TAMs that are smaller.
Yes.
Because that's going to stay out of the reach of the...
That's very insightful.
Traditional VCs. They're going to go for the $1 billion TAMs. If you can go for a TAM that is a bit smaller and can establish hypergrowth within a smaller TAM that might still score an exit. That's the way I would build your...
That's a really insightful comment. We just invested in a company called NQS. It's a software platform for trauma departments in hospitals. And there's only one product in the market. It's called ESO. It's a very bad product. And they're the only competitor because the TAM's about $250 million in total. It's a tiny TAM. But we believe that within 18 to 24 months, this founder with his product can capture probably 50 to 60% of the TAM.
There you go. That's the strategy.
And nobody else is there, Sramana. No one else is there. And so to connect all the dots, this person has spent 20 years, his name's Mark, Feinberg, he spent 20 years in trauma. He understands it intimately. He knows why people need what they need solved. Yeah. And we're so fired up about it. That is such a great comment. It is so counterintuitive, but it comes back to the whole point. Build what's right for you. Yeah. Build what's right for you. Find the thing that you are gifted at and uniquely equipped to win at. And I think that is when success will follow.